welcome to Hansen Vietnam Joint Stock Company. Since 2014, Hansen Vina has been bringing modern living spaces to life with premium, stylish furniture made for comfort and durability. From cozy homes to vibrant offices and elegant commercial spaces, they don't just sell furniture, they create complete interior solutions. Backed by nearly a decade of experience and a passion for design, Hansen Vina is proud to be a trusted name in Hanoi's competitive market, always pushing forward with quality, innovation, and customer satisfaction. First, for the commercial due diligence, let's briefly explore Hansen Vina's business model. The company generates revenue mainly through furniture sales, interior designs, and full package construction projects, with additional income from after-sales services and contracts with hotels, offices, and government agencies. Their core activities include furniture productions, interior installations, and project consulting, all supported by a skilled in-house team. What makes Hansen Vina stand out is their focus on quality, modern design with a Vietnamese touch, and their commitment to personalized service and reliable after-sales support. Now that we have seen how the business generates revenue, let's move to the evaluation table to comprehensively understand the company's current challenges and potential. In this video, we'll only focus on the most critical factors impacting the company's future, starting with pricing power, brand strength, and market share in this section of commercial due diligence. First, pricing power is limited. Although the company targets middle to high-income customers, they face a price-sensitive market with strong competition. This puts pressure on their ability to increase prices, which is a medium risk. Second, Hansen Vina is still developing in Vietnam, and its local brand awareness remains low. Without greater investment in marketing and public relations, it will be difficult to build customer trust and loyalty. This is also a medium risk. Finally, the most significant issue is market share. Hansen Vina currently hold less than 5% of the market share and operates with just 21 employees. They are competing directly with large, well-established brands, so this is considered a high risk and a major barrier to growth. However, the company still has room to grow. Vietnamese urbanization, rising incomes, and growing demand for premium furniture offer strong market opportunities moving forwards. Addressing these key risks while seizing growth opportunities will be crucial for Hansen Vina's long-term success. Next, as part of our operational due diligence, here's a quick walkthrough of our end-to-end process. We start with competitive bidding, win the projects, and move to design and client discussions. Next, we handle raw material sourcing, build a pre-production sample, then proceed with cutting, drilling, assembly, and quality checks. Finally, it's onto packaging, delivery, and final assembly, bringing the finished product to life. That is our current SOP in action. Besides, we also found a robust set of policies in place regarding quality management, production and operations, environment, health and safety, warranty and customer service, supply chain management, and business ethics and compliance. These policies are well structured, reflecting the nature of Hansen Vina's project-based manufacturing model, and are being implemented with a fair level of effectiveness in practice. Next, let's review Hansen Vina's KPIs through 5 important charts: safety rates, project on-time completion rate, labor structure, production time based on product complexity, and average product defect rate. Overall, the KPIs suggest that the company's operations are generally stable, but still have room for improvement. The product defect rate stands at 8%, which is acceptable, but higher control is needed for premium products. Production time remains heavily dependent on manual labor, especially for complex design. The labor structure indicates low automation, highlighting the need for further machinery investment. While the current KPIs cover essential areas like production, quality, human resources, project timelines, and safety, they still don't fully capture potential risk in supporting or indirect processes. Based on our review of the SOPs, policies, and KPIs, here is a high-level evaluation of Hansen Vina's operational due diligence. The supply chain is stable, with no major concentration risk. However, operational efficiency is a concern, with noticeable waste and reliance on manual labor. Facilities and equipment are serviceable but dated, with reactive maintenance practices. On the policy front, the framework is strong and well aligned to the business model, yet implementation remains inconsistent, creating a gap between policy and execution. Finally, while KPIs are clearly defined, they need tighter alignment with day-to-day operations. This gives us a clear view of strengths, weaknesses, and areas for improvement in operational backbone of Hansen Vina. For the financial due diligence, we'll begin with a review of performance from 2022 to 2024, highlighting a solid upward trend. In 2024, Hang Seng's revenue reached over 2,059 billion Vietnam dong, showing steady growth from 2,011 billion Vietnam dong in the previous year and a significant leap from 1,607 billion in 2022. Gross profit margin also improved meaningfully, rising to 24.6% in 2024 compared to 19 to 20% in the previous years, reflecting stronger cost control and pricing strategy. Moreover, when excluding one-time losses of nearly 78.9 billion Vietnam dong, the company's core operating performance shows positive momentum and potential for a healthy, normalized EBITDA. With that financial backdrop in mind, let's break down our findings across 6 key financial areas. Revenue and profitability shows consistent growth, but profits remain volatile due to irregular income and one-off expenses, earning an average rating. Next, while gross margins have improved significantly in recent years, their long-term sustainability remains uncertain, so we assess margins and cost management as not good. In terms of capital structure and leverage, the company is on solid ground with minimal debt and no negative equity, a clear good. Cash flow and working capital fluctuate with production cycles, which is expected in a project-based model, but the volatility brings this to an average. When it comes to financial controls and reporting, Hang Seng Vina performs well. Reporting is clear, controls are intact, and there is no tax or legal concerns. This earns a good. Finally, while accounting practices appear prudent, there is room for more alignment with industry best practices, resulting in an average rating. Overall, this financial foundation is stable, but there are key areas that warrant attention for long-term resilience. For the last due diligence, which is the legal one, we'll begin by walking you through the corporate structure firsthand. Hang Seng Vina has a clear specialized structure with 3 main divisions: technicals, business, and human resources, each managed by a deputy director under the general director. This structure ensures smooth operations, clear contract authority, and minimized role conflicts thanks to well-defined responsibility and no overlapping positions. Along with its clear organizational structure, Hang Seng Vina also has a highly concentrated ownership, with 5 key shareholders controlling over 90% of the company capitals. This can streamline decision-making but may pose governance challenges. In terms of intellectual property, or IP, the company focuses on securing design rights on a project-by-project basis, especially for bidding. However, it currently lacks a comprehensive IP protection strategy. More importantly, regarding its regulatory compliances, Hang Seng Vina was established strictly in accordance with the law, with Enterprise Code of 010663852, initially registered on 16 of September 2014 and last updated on 11 October of 2016. The company operates as a joint stock company, and Mr. Nguyễn Minh Hải is the legal representative. As of the time of assessment, the company shows no sign of administrative violations or being subject to legal proceedings. The business license, registered address, and representative information are all clear, consistent, and free from any existing legal conflicts. As a result, in our legal due diligence, Hang Seng Vina demonstrates strong compliance and transparency across most areas. The company is legally established, probably registered, and shows no sign of conflict or unclear ownership. Its organizational structure is well-defined, with clear roles and no overlap or concentration of power. There are no legal violations, pending sanctions, or ongoing litigation report as of the assessment date. However, the 2 warrant attention. As a result, in our legal due diligence, Hang Seng Vina demonstrates strong compliance and transparency across most areas. The company is legally established, probably registered, and shows no sign of conflict or unclear ownership. Its organizational structure is well-defined, with clear roles and no overlap or concentration of power. There are no legal violations, pending sanctions, or ongoing litigation report as of the assessment date. However, the 2 warrant attention: the concentration of ownership among a few major shareholders, which may pose governance risk, and the limited intellectual property strategy, which could leave the company exposed to competitive copy. To conclude the legal due diligence and integrate it with our previous analysis, we have summarized the overall key risks and key upsides of Hang Seng Vina into a final evaluation. Briefly, the company carries manageable risk, including project-based revenue dependence, small market share, manual production limitations, and limited intellectual property protection. However, these risks are balanced by notable upsides such as strong market growth, a stable supply chain, low financial leverage, and full legal compliance. After considering both sides, we believe the base case scenario is the most appropriate for Hansen Bina valuation. The risks are moderate and can be addressed with the right strategic improvements. Therefore, we recommend a conditional buy, as a buyer should proceed with the acquisition only if they commit to improving brand visibility, enhancing maintenance practices, proactively protecting intellectual property, and strengthening internal controls. With these conditions in place, Hansen Bina has the potential to grow sustainably in the competitive furniture market.